Jobs report disaster. Fed forced to cut rates more quickly. Economic data has the power to move financial markets, influence household decisions, and shift global capital flows. Among all indicators, the monthly US jobs report, formerly known as the Employment Situation Report, is often considered the most important. It provides insights into how many jobs were created or lost, the unemployment rate, and wage growth trends. Recently, a disastrous jobs report sent shockwaves through Wall Street, forcing the Federal Reserve to reconsider its timeline for interest rate cuts. Why the jobs report matters. The jobs report is not just about numbers. It reflects the health of the US economy, which is the largest in the world. Strong job growth signals robust consumer spending, while weak job creation suggests businesses are struggling. Since consumer spending accounts for nearly 70% of US GDP, employment data serves as a reliable barometer for future growth. When the report shows disappointing job creation, or worse, job losses, it often raises fears of a slowdown or recession. In such cases, the Federal Reserve, which sets monetary policy, must balance its dual mandate, keeping inflation under control while also promoting maximum employment. The disaster in the report. The latest report revealed a sharp decline in payroll growth, with far fewer jobs created than expected. The unemployment rate ticked higher, and wage growth slowed, signaling that both businesses and households may be under pressure. For policymakers, this is a dangerous combination. Slowing wage growth reduces consumer purchasing power, while rising unemployment weakens overall demand. If the trend continues, the economy could tip into recession, something the Fed wants to avoid at all costs. Why the Fed is forced to act. The Federal Reserve has been raising interest rates aggressively over the past 2 years to fight inflation. Higher borrowing costs for mortgages, auto loans, and business financing cooled demand and slowed price increases. While inflation has eased, it remains slightly above the Fed's 2% target. Normally, the Fed would hold rates steady until inflation is firmly under control. However, a disastrous jobs report changes the calculus. Rising unemployment means people lose income, businesses cut back, and confidence declines. To prevent a downward spiral, the Fed may be forced to cut interest rates sooner and more aggressively than originally planned. The balancing act. Cutting rates too quickly risks reigniting inflation, but waiting too long risks deepening job losses and slowing growth further. This balancing act makes monetary policy one of the most challenging areas of economics. The Fed's decision-making is also influenced by global factors. With many countries struggling with sluggish growth and geopolitical tensions, US economic weakness could spill over internationally. Investors around the world closely watch the Fed's moves as they affect exchange rates, commodity prices, and global capital flows. Market reactions. Unsurprisingly, financial markets reacted strongly to the jobs report. Stocks initially sold off as traders feared that economic weakness could hurt corporate earnings. Bond yields, however, dropped sharply as investors bet on faster Fed rate cuts. Gold and other safe haven assets gained, reflecting rising uncertainty. Cryptocurrency markets also moved higher, fueled by speculation that looser monetary policy could boost liquidity and investor appetite for riskier assets. What it means for households. For ordinary households, the Fed's response has real consequences. Lower interest rates reduce borrowing costs, making mortgages, credit cards, and auto loans more affordable. On the other hand, savers may see lower returns on deposits. Job security remains the biggest concern. If businesses continue to cut workers, even cheaper credit may not offset the anxiety of rising unemployment. The road ahead. The coming.